Ladies and gentlemen, welcome to my lecture series in Fractal Finance. This lecture series is based upon the book entitled The Misbehavior of Markets, written by Benoit Mandelbrot. Who was Benoit Mandelbrot? If you Google him, you will find on Wikipedia that Benoit Mandelbrot, born in November 1924 and passed away in October 2010, he was a Polish-born French-American mathematician and polymath with broad interest in the practical science, especially regarding what he labeled as the art of roughness, of physical phenomena, and the uncontrolled element in life. He referred to himself as a fractalist and is recognized for his contribution to the field of fractal geometry, which included coining the word fractal, as well as developing a theory of roughness and self-similarity in nature. Toward the end of his career, he was Sterling Professor of Mathematical Science at Yale University. Besides that, Mandelbrot had significant contributions to the field of finance as well. His book chapter, The Variation of Certain Speculative Prices, which is a part of his book Fractals and Scaling in Finance, published in 1997, has more than 10,000 citations. And the content of that book chapter is based on his research article entitled The Variation of Some Other Speculative Prices, published in the Journal of Business, volume 40, in October 1967. So this research is already more than 50 years old, but it is still up to date. His outstanding research is the foundation for a new field of finance, which I would like to refer to as fractal finance, which in essence challenges the whole field of traditional finance and the actual scientific contributions of several Nobel laureates, as we will see. So the first lecture of this lecture series is entitled Questionable Research in Finance. How much worth is Nobel Prize in Economics? And what you see here is a picture from a teaching of Benoit Mandelbrot, and I suppose that he might be here in his late 40s. So everything has a foundation and a beginning, and this is also true for finance. So the foundation for what we got to know or what is taught in business schools in finance, it goes back to Louis Bachelier, who had a PhD thesis entitled Theory of Speculation. It was written in French originally. Louis Bachelier was born in March 1870 and passed away in April 1946. So who was Louis Bachelier? Well, he was a French mathematician who explored French government bonds and introduced the normal distribution as the underlying distribution for financial returns. And in this notation that we choose here, xi t, it denotes the payoffs or the return of asset I at time t. And in this notation, which you see here, it is distributed as normal with mean mu I and variance sigma I squared. Let's have a closer look at that on the whiteboard. So what do we learn from Louis Bachelier? Here on the whiteboard, we see the normal distribution, the classic bell curve, and you see here in the middle the mean, 0, and here 1 standard deviation, 2 and 3 standard deviation on the right hand side, and here on the left hand side -1 standard deviation, -2 and -3 standard deviations. The normal distribution is characterized by only 2 parameters, which is the mu, the expectation, which is here 0 for the standard normal distribution, and the variance sigma square. So the parameter vector is fully specified by mu and sigma square. If the distribution is normal, obviously, if it's standard normal, then mu is equal to 0 and the sigma square is equal to 1. Yeah, and we write it as random variable x, yeah, follows a standard normal distribution with mean mu equal to 0 and variance equal to 1. It is interesting to note, and you should know that from statistic classes or from econometric classes, that any normally distributed random variable can be transformed to be standard normal by the standardization. And how does it work? Well, let's say the return of asset I is denoted here as xit. It's the return of asset I at time t minus the corresponding mean, mu I, the mean of asset I, divided by the standard deviation of the corresponding asset. Yeah? So for each observation, for each time series observation, yeah? So if we have here a time series, we have here the x, and here here it's the t, and here we have x, and we have here a time series. So you take every guy from time series, subtract the sample mean, divided by the standard deviation, and you do this for every individual observation here in our time dimension, and by this you get the standardized series. So it is interesting to know if we operate with the normal distribution, and in this case with the standard normal, and recall again, we can transform any normal distribution to be standard normal, yeah, by this simple transformation here. It is interesting to know that within -1 and +1 standard deviations here, obviously, so at this area we have 68% of the sample observations. Moreover, if we go from -2 standard deviations, yeah, to +2 standard deviations, we have 95% of the observations. Whereas if we are between -3 and +3 standard deviations, so in this area here, if we take the whole area, yeah, we have 98% of the whole sample observations. And what does that mean at the same time? It means as we move from 1 to 2 standard deviations, yeah, we just have to subtract now the difference here, we have 27% of sample observations. Right? And as we move from 2 standard deviations to 3 standard deviations, so from here to here, so in this area here, respectively, this area here, yeah, we have 3% of the observations. Yeah? It's the difference between these densities. So recall. So what we see is as we move away from the center, so the likelihood to have observations generated there decreases exponentially, okay, and at an exponential rate. Yeah, so we see as we move from the center from 1 to 2 standard deviations is 27%, and as we move from 2 to 3, which is the same distance here on the x-axis, it's only 3%. Yeah, and so on. So if we are at 6 here, it's 0. It is very, very unlikely to have observations, or it's virtually 0 in finite samples that are, let's say, 6 standard deviations away from the center. So everything in the standard normal distribution, everything basically is here. So the whole movement of the data generating process is very much centered. Yeah? And there are no large standard deviations possible. The stock market crash as of 19th of October 1987 corresponded to a 22 sigma event. according to Benoit Mandelbrot. And the odds that something like that happens, 22 sigma event, yeah, is 1 to 10 to the power of 50. So I don't know that number, okay? I cannot even imagine that number, but it is very, very, very small. It's a number that is outside the scale of nature, okay? You would never, never, ever observe that number. So interesting things with some interesting issues with the standard normal distribution is we can compound the moments, the central moments. So as we already said, the mean, mu, is the expectation of x is 0 for the standard normal distribution. The second central moment, which is the variance, it's the expectation of x to the power of 2, it's sigma squared, and it's 1 for the standard normal distribution, as we already pointed out. The third central moment, which is the skewness, it's the expectation of x to the power of 3, it's 0 for the standard normal distribution. Okay, what does that mean? So it means that the mean is here. Yeah, it's centered. So if it's minus, if this guy would be minus, let's say minus 0.5 or so, then this distribution would be here. Yeah? The center would be to the area where it's negative. And when it's positive, if it's positively skewed, this is a skewness, right? If the expectation from x to the power of 3 is positive, then we would obviously observe something like that. Yeah? Moreover, the fourth moment, which is the kurtosis, it's the expectation of x to the power of 4. It's for the standard normal distribution 3. Yeah? So whenever the kurtosis is larger than 3, obviously we are dealing with a distribution where we observe observations that are far away from the center that we would not observe in the normal distribution framework. Yeah? So these are the properties or the most important properties of the standard normal distribution, and this is the foundation for traditional finance research, and it rests upon the PhD thesis from Louis Bachelier from 1900. The first Nobel Prize, based upon the foundation laid from Louis Bachelier, has been received in 1990, and it was Harry Markowitz who was awarded the Nobel Prize of Economics. Every Nobel Prize winner has a reference paper that is basically on which the Nobel Prize is based upon in essence, and this corresponding reference paper of Harry Markowitz was entitled Portfolio Selection, published in the Journal of Finance in 1952. Yeah. Harry Markowitz was born in August 1927, and as of recording this lecture, he is still alive. So, who is Harry Markowitz? Well, he is an American professor of finance at the Rady School of Management at the University of California, San Diego. And he is known for his pioneering work in modern portfolio theory, studying the effects of asset risk, return, correlation, and diversification on probable investment portfolio returns. And in order to have better understanding what all this is about, modern portfolio theory, let's have a closer look at that on the whiteboard. So what do we learn from Harry Markowitz and his pioneering work concerning modern portfolio theory? So let's assume we have two stocks or two assets, A and B. Let's say the first stock, A, generates, or you expect, a return of 5%, and the second asset, the second stock, B, would generate a return or an expected return of 10%. Let's say if you like to allocate 40% in stock A and 60% in stock B. So what's the expected portfolio return? Well, the expected portfolio return is 0.4 times 5% plus 0.6 times 10%, which is 8%. But what about the portfolio risk, respectively the portfolio variance? So the portfolio variance, in line with Markowitz, is given as, or denoted here as sigma p squared, p for portfolio variance, is given by what? The weight allocated in asset A squared times the variance of asset A squared plus the weight allocated in asset B, VB squared times the variance of asset B plus 2 times the weight allocated in asset A times the weight allocated in asset B times the correlation between asset A and B. And what's the correlation? The correlation, you know from statistics class, you can rewrite the correlation as what? It's the covariance, the sigma AB, the covariance between asset A and B divided by the standard deviation of asset A times the standard deviation of asset B. And note that the correlation coefficient is defined between -1 and 1. -1 when it's perfectly negatively correlated, and 1 when it's perfectly positively correlated. Using this formula in line with Markowitz, say now the standard deviation, respectively volatility, as financial economists used to say, is 10%, and the volatility sigma b of asset B is 15%. Using these figures, we can easily just plug it into this formula. And what we get is then for the portfolio variance sigma p squared, it's 0.4 squared times the weight 0.1 squared plus 0.6 squared times the weight 0.15 squared plus 2 times the weight 1 in asset A, 0.4 times weight in asset B, 0.6 times the standard deviation of asset A and standard deviation of asset B times the correlation. So we have to add here, obviously, the standard deviation times sigma A times sigma B, okay? So now it's correct. So and then we can ask, okay, what if as we already said, the correlation coefficient is defined between -1 and 1. So we can now ask us, okay, what if the correlation is 1? Well, if the correlation is 1, if this guy here is 1, then this whole term here, this whole term is added, obviously, to this term previously here. So we have to add the whole guy. And if we calculate it out and take the square root here, because the volatility is simply the square root of this variance here. So if you take the square root of this guy here and set rho equal to 1, we can calculate that the portfolio volatility is equal to 13%. So what if the correlation is perfectly negative, so which is the other extreme scenario? Well, if the correlation is assumed to be perfectly negatively, then we again use this formula here. What it means is that this guy here has to be subtracted. So the portfolio volatility or variance decreases. So and then if we calculate it out, it's just we see that the portfolio volatility in case of a perfectly negatively correlated assets is only 5%. So in this case, obviously, we would choose assets that are perfectly negatively correlated, right? If we can choose. We can extend this Markowitz model to many assets, what you will typically learn at business schools. We can then we have this sigma p, this risk return space, and here we have the expectation of p. And what you see typically is this optimal portfolio allocation line, right? So, and you know, obviously, that you only invest in the upper part, yeah, and here is the minimum variance portfolio, obviously, yeah, and you would not invest into the lower part of that, because for each unit of risk, of standard deviation, you would get here, if you are on this curve and above the minimum variance portfolio, you get a higher expected portfolio return. That's why you would not invest, a rational investor would not invest into this lower part of that curve. So, using this Markowitz model, you can engineer portfolios, yeah, for every risk you wish to have in your portfolio. You get a corresponding weight allocation of which you would choose for your assets, yeah? And you get the corresponding highest possible expected return for your set of assets. Yeah? This is basically what we learn from Markowitz. Yeah? We have this mu sigma space, yeah? Where we basically, and from this space we can derive the optimal portfolio allocation given we have a certain sets of assets, right? And we can engineer portfolios. Either we can use certain, we can go this direction, that we say, okay, we want to take certain risks, what's the optimal or the highest portfolio return that we can get, or the other way around, we can say, okay, we want to have a portfolio return of, let's say, I don't know, 15%, give me the optimal or the lowest possible risk. Yeah? So both ways is possible. This is what we learned from Markowitz, and again, recall that we are in a mu sigma space, and recall that it is the normal distribution that is defined by these two parameters. Yeah? So that's basically the correlation, variance. These are the metrics that are designed for normally distributed random variables. The second Nobel Prize, which has been awarded based upon the foundation laid originally from Louis Bachelier, has been awarded to William Sharpe, and this was also in 1990. William Sharpe, born in June 1934, and the reference paper is entitled Capital Asset Prices, a Theory of Market Equilibrium under Conditions of Risk. It's also published in the Journal of Finance in 1964, which might be not surprising. So, who is William Sharpe, or what is he known for? Well, he is also an American professor of finance at Stanford University, and he is known to be one of the originators of the capital asset pricing model, the CAPM, which you might know if you are a finance student. And he proposed the Sharpe ratio for performance analysis, contributing to the development of methods for the valuation of options and return-based style analysis for evaluating the performance of investment funds. So what was the model for what he received the Nobel Prize? The CAPM, the well-known CAPM. Let's have a closer look at it on the whiteboard. So what do we learn from William Sharpe? William Sharpe obviously extended the work from Markowitz, surprise, surprise. Yeah, we recall from Markowitz the optimal allocation line here, which is given here in red, and he introduced the so-called market portfolio. Yeah. He derived the reward to risk ratio, yeah? And the market portfolio obviously maximizes the reward to risk ratio. Yeah? Reward, again, it's the expectation of a portfolio return, and the risk is the given portfolio risk. And introducing a risk-free rate into this risk return diagram, so we see that the straight line from the risk-free rate to this the optimal portfolio function. There we have the market portfolio. Yeah? Here we have the maximum reward to risk ratio. Yeah? We maximize here the reward to risk ratio. And provided we have rational investors and who act as one representative investor, yeah, a rational individual or the representative investor would only invest in the market portfolio. Yeah? So this is basically what we learn, because here we maximize the reward to risk ratio. And depending on your utility function, on your individual utility function, you would invest, let's say you are risk loving, yeah, you want to leverage your wealth, your invested amounts in risky assets. Yeah, let's say you are risk loving, you could basically have, if you have your preference function here, yeah, you might recall that from your finance class, you might leverage the amount invested in the market portfolio. Yeah? But still, you would invest in the market portfolio, but you would go to the bank, borrow money, and invest more in the market portfolio, more than 100%. If you are risk averse and you would want to, let's say, only invest half of your wealth into the market portfolio, and the rest, you leave the rest on the bank account or choose bonds instead, it could be that if your preference function is here, okay, you would invest in the risk-free rate and only some part in the market portfolio. But again, it's important to note that you always invest only in the market portfolio, yeah? Irrespective of which are your preferences. Yeah? So that's the important point, and this is what Sharpe basically derived in this framework. And again, we are in a sigma or a standard deviation and expected return in a mu and a sigma space. Okay, only what matters is the first and second moment here, obviously. And again, this is designed for normally distributed payoffs. All right. What else can we say? Well, we can say that every asset, yeah, let's say R is the return of asset I, the expected return of asset I is priced with respect to the market portfolio only. Okay? So what is it? We can calculate the expectation, the expected return for asset I simply, it's given by the risk-free rate plus the exposure, now the beta exposure, the loading against what? Against the market, against the expected market return minus the risk-free rate. Yeah, so we can price every asset, the expected return of every asset, yeah, should be given by this equation here. Given that that Sharpe's theory, the capital asset pricing model, that this is true. Okay, this is what the capital asset pricing model predicts. Yeah? Given we have the market portfolio that the representative investor would choose to invest in. Then we can simply rewrite this. We can bring the risk rate on the left-hand side. We can subtract every return lowered by the risk-free rate here. Then we define this as the excess return of asset I. So the expected excess return of asset I is given by beta, the corresponding beta, the individual assets beta, beta I, times the expectation of the excess market return. Yeah, we just subtract here the risk rate from the market portfolio and define this as the risk-free, as the excess return. So, given this framework here, you might recall from finance classes that you can derive the security market line, SML. Yeah? So we have on the x-axis here the individual beta I from the corresponding asset, and here on the y-axis we have the expectation of of the returns of asset I. So, and simply, if this model is true, all of the assets should line up here on the security market line. obviously, per definition, the beta of the market portfolio is 1 per definition. Yeah? So if a stock has a beta that is larger than 1, obviously the expected return should be higher than the expected return of the market portfolio. Whereas if an asset has a beta that is lower than 1, the expected return of that asset should also be below the market portfolio. All right. So this is basically what we learn from Sharpe's capital asset pricing model. All right. Now we can also ask us the question, okay, how is the beta defined? The beta is usually defined as we have here. It's the covariance between asset I and the market portfolio, yeah, divided by the variance of the market portfolio. Yeah, so this is an important to note. We will come back to that later on in more detail. So we require that we have the variance. So the variance must exist. Okay, it's an important ingredient of the whole model framework. Okay, the variance of the market factor must exist. The variance of the assets must exist. Yeah, they must be defined. And we need the covariance here as well. So, and we know or we recall that the covariance and correlation, they are concepts that belong together. Okay, you can rewrite the covariance in terms of its correlation times the standard deviation, as we have seen when we talked about Markowitz. Yeah, so the concept of correlation and covariance and variance it's related to each other, and it rests upon the assumption of normally distributed payoffs, respectively returns. The third Nobel Prize, which has been awarded based upon the foundation laid from Louis Bachelier, was given to Robert Merton, born in July 1944. The reference paper was entitled Theory of Rational Option Pricing, published in the Bell Journal of Economics and Management Science in 1973. Who was Robert Merton? Well, he was a professor at the MIT Sloan School of Management, known for his pioneering contributions to continuous time finance, especially the first continuous time option pricing model, the Black-Scholes-Merton model. In 1993, which is interesting to know, Merton co-founded the hedge fund Long-Term Capital Management, which is usually abbreviated LTCM. And this is an interesting issue, which we will come back later on. The fourth Nobel Prize, again, based upon the foundation laid from Louis Bachelier, has been awarded in 1997 to Myron Scholes, so in the same year as for Robert Merton. Who was Myron Scholes, born July 1941? Well, he was a Canadian-American financial economist, the Frank E. Buck Professor of Finance at the Stanford Graduate School of Business, known to be the co-originator of the Black-Scholes or Black-Scholes-Merton option pricing model. In 1994, Scholes co-founded the hedge fund Long-Term Capital Management, like Robert Merton. So both of them received the Nobel Prize for basically the same thing. And let's have a closer look at that on the whiteboard. So what do we learn from Nobel laureates Myers and Scholes? Yeah, both got the Nobel Prize of Economics for their option pricing formula. So what's an option? Well, an option gives you the right to buy a certain asset, let's say a stock, to a certain price in the future. Yeah? And for that, you have to pay the option premium. There are call options and put options, yeah, depending on your view, depending on whether you expect prices to fall or to rise. So depending if you expect rising prices, obviously you would purchase a call option. If you expect prices to fall, you would prefer put options. So the well-known option pricing formula is here on the whiteboard. Yeah. C0, yeah, it is the price of, let's say, call option. Let's consider now call option. Let's say you are an optimist, you expect prices to rise, okay? So C0 is the price of a call option at the current time T0, and what is it? It's equal to capital S0, and that is the current stock price now at time 0, times probability derived from a normal distribution. Yeah? That's why it's a capital N, and D1 is a figure which is based upon the normal distribution, minus X, which is the exercise price, which is the price where you basically which is the agreed price in the option at the time of maturity, yeah, times E, which is an exponent, to the power of minus R, which is the risk-free rate, times capital T, which is the remaining time to maturity, times, again, something that is derived, a probability derived from a normal distribution, okay? So, how do we proceed then? So let's first calculate D1, the figure D1. What is it? Well, we have in the denominator the natural logarithm of the current stock price over the exercise price, yeah, plus what? In parentheses, we have risk-free rate plus the sigma square over 2, and sigma square is the variance of the underlying of the stock, okay, times time to maturity. And in the denominator, we have sigma, which is the standard deviation of the stock, times the square root of capital T. What is D2 here? Okay, the second figure, yeah, based on the normal distribution, is simply the first figure, D1 minus sigma times the square root of capital T. So let's say now, okay, the stock price is now $100, the exercise price, so the price where you basically, where you agree on to buy the stock is 95, so it's a at the money option, because the exercise price is close to the current stock price, all right, then it's at the money. The risk-free rate, let's assume it's 10%, and we have 3 months time to maturity. Let's say also that the standard deviation of the stock is 50%. If we plug that in, the corresponding figures, we will get that D1 is 0.43, whereas D2 is 0.18. So how do we have to interpret these figures? So we have let's say we have the normal distribution, and if we take the integral from minus infinity to 0.43, which is this probability mass, so it's the probability of x smaller than 0.43, and that's corresponding to 0.6664. It's 66.64% probability. In the same manner, again, we have the normal distribution. The D2 was 0.18. So if we take the integral from minus infinity to 0.18, given we have the normal distribution, there are, and again, what does it mean? It's the probability of x smaller than 0.18. Okay, the corresponding probability mass here is 0.5714. It's 57.14% probability. Using these numbers here, we can plug everything now in our formula here. So again, we say that the stock price now is 100, so it's 100 times the corresponding probability here, calculated 0.6664 minus what? Minus x, which is the exercise price, which is 95, times exponent, and you know this number is something like 2.7, to the power of minus 0.1, because we have 10% interest-free interest rate. It's minus 0.1 times time to maturity. Time to maturity is 3 months, so it's 0.21. Yeah, so obviously it is normalized. Okay, so then times the corresponding probability D1, D2, sorry, which is here calculated as 0.5714. Now, if we multiply this out here and calculate it correctly, the corresponding price of the option C0 should be $13.70. Okay, so again, the whole model here, the whole option pricing model, is based upon the assumption of the normal distribution, yeah? That we have the normal distribution of the payoffs. And now recall that these Nobel Prize winners, Myron and Scholes, Beck didn't get the Nobel Prize, obviously, but Merton and Scholes, that they also joined the hedge fund long-term capital management. Yeah? So where they also employed their formula and their methodology. Next, the 5th Nobel Prize has been awarded in 2003 to Robert Angel, born in November 1942. The reference paper for which he received basically the Nobel Prize, or for which the award has been based upon, is entitled Autoregressive Conditional Heteroskedasticity with Estimates of the Variance of United Kingdom Inflation, published in Econometrica in 1982. Who was Robert Engel? Well, he was an American economist and statistician at New York University, Stern School of Business, where he is the Michael Armelino Professor in Management of Financial Services, known for developing methods for analyzing economic time series with time-varying volatility, or ARCH, which stands for, or which is the abbreviation for autoregressive conditional heteroskedasticity. So this research, he received enormous attention, and there are many follow-up papers, and this is actually true for all of the Nobel Prize winners. All of their research has been cited thousands of times and received enormous attention and follow-up research. So what is the ARCH model about? Let's have a look at that in detail on the whiteboard. So what do we learn from Robert Engel? So Robert Engel was the first to recognize, at least according to the literature, that financial asset returns tend to cluster. So we have, if this is the timeline T, and here's the return on the y-axis, the return of asset R at time T, we see that in the beginning of the sample, we have a period of low volatility, which alternates with the period of high volatility, and so on. And this continues across time. So we have periods of low volatility and periods of high volatility. They tend to alternate. And how do we model that? So Robert Engel proposed what we nowadays know as ARCH model, autoregressive conditional heteroskedasticity. And here we can formalize an ARCH-P process. Let's just look at the first equation here, which is the mean equation. The return of financial asset R at time T is given by what? We have a mean mu plus the lagged value of that financial asset at time, so it's beta time R at T minus 1, and we have a disturbance or an error term UT. That's the mean equation, and obviously we can include many lags here of our financial return. So then we have here even more parameters to estimate. Here for the mean equation, in this case, we have only 2 parameters. And obviously, there's some evidence for weak autocorrelation in financial assets, and the recent literature on factor momentum actually suggests that on a portfolio level, there's a quite strong evidence for autocorrelation of financial returns. So we have then, as the next equation is the equation for the error term. How do we model the error term that should capture this volatility clustering here? So we model the UT. UT is given by what? It's the sigma square. It's the sigma t. It's the conditional standard deviation or conditional volatility times epsilon t. So how do we model the conditional standard deviation? The conditional standard deviation, which is the square root of the conditional variance, that's why we have here the square root, is given by what? We have, again, an intercept term, which is the conditional standard deviation if we have here no variation, if the UT's squared are 0. So we have here an intercept term W 0 plus alpha 1 times the squared lagged residual at time t minus 1, okay? And we square this guy. Plus alpha 2 times the squared residual at time t minus 2, and so on until alpha p times ut minus p squared. So we have order of p, and p can be anything, any natural number. So then the interesting thing here, or the important thing with this arch-p model, is that we assume that the epsilon, this innovation part where the innovation enters, because this is a deterministic model, the arch-p model, and the randomness obviously enters the equation here, the whole equation part here, with this epsilon t. And epsilon t in the original model is assumed to be what? It's assumed to be normally distributed with mean 0 and variance of 1. So the parameter vector that we have to estimate using this model here, it's estimated using maximum likelihood estimation, and given that the error terms are not normally distributed, it's called quasi-maximum likelihood estimation. So the parameter vector that we have to estimate here, so we get obviously the parameter vector phi hat, and what does it contain? Obviously the parameters from the mean equation, which is mu hat, beta hat, and the corresponding parameters from the variance equation, respectively the equation for the conditional standard deviation. And then we have obviously omega 0 hat, alpha 1 hat, alpha 2 hat, until alpha p hat. So as we extend this model, we have more and more parameters to estimate. So we need a lot of observations, obviously, in order to run this model properly. Then an interesting thing is that obviously the conditional expectation of the error term using this model here is 0. And why is that? Simply because this guy here we know, because it only contains lagged squared residuals, right? So and at time t, we know already the realizations from time t minus 1 until time t minus p. So this guy here is known. So if we want to calculate the expectation of ut, it's what? And we have the expectation is equal with the expectation of sigma t times epsilon t times epsilon t. So we can move this expectation operator inside, because that's not random here, that's deterministic, right? So, and we know the expectation of this guy here. So it's sigma t times the expectation of epsilon t, and this is 0 according to our assumptions, right? Because it's normally distributed with mean 0 and variance of 1. So that's why the conditional expectation of this error term here, it must be 0. And using the law of iterative expectation, we can show that also the unconditional expectation of this guy here must be 0. And this model here adds or lines up nicely with the efficient market hypothesis, all right? Because of these properties. And in the literature, obviously, because this model, it's a nice beginning, and we know already, or what we will see throughout this lecture, that the problematic assumption is obviously here, the assumption for the error term. So in the literature, there have been different models proposed to extend the original arch model, the Garch model, for instance, where we basically summarize the infinite past here. We have then this sigma. We have then basically here a Garch term and a arch part. We have the T-Garch models, where we basically want to account for that negative innovations or that negative realizations in the innovation process have a higher impact than positive ones. So we can add different parameterizations of that model here. Yeah, and we can even have different assumptions for the innovation process. Okay, some literature suggests a t-distribution here or a generalized error distribution. So the literature came up with many fixes in order to get these models straight. Okay, so that's the ARCH-P model as proposed from Robert Engel in 1982. Finally, the sixth Nobel Prize, based upon the foundation laid by Louis Bachelier, has been awarded in 2013 to Eugene Farmer, born in February 1939. And this reference paper was entitled Common Risk Factors in the Returns on Stocks and Bonds, published in the Journal of Financial Economics. Who was in 1993, by the way. So who was Eugene Farmer? He was an American economist known for his empirical work on portfolio theory, asset pricing, and the efficient market hypothesis. He is currently Robert R. McCormick, Distinguished Service Professor of Finance at the University of Chicago Booth Business School. So one thing that is interesting to know about Eugene Farmer, Farmer happened to be the doctoral student, back in the days, the doctoral student of Benoit Mandelbrot. And we will come back to that later on in more detail, but as for now, let's have a closer look on the model for which Eugene Farmer received the Nobel Prize. So what do we learn from Eugene Farmer, who won the Nobel Prize in 2013? Well, Eugene Farmer proposed this asset pricing model, and actually he proposed it together with his co-author Kenneth French. So it's the well-known Farmer and French three-factor model. So we have the expected return of asset I in excess form is given by what? It's beta 1 of asset I times the expected return of the excess market factor plus the beta 2, the exposure against what? Against the SMB, the size factor, times a parameter beta 3 of asset I times the expected value of the value factor. HML stands for high minus low book to market ratio. So what are these portfolios here? Obviously, the market factor is the standard. It's usually approximated by, let's say, the S&P 500 in the US or the Dow Jones 30 or the CRISP, so-called CRISP index. The S&P, which is the abbreviation for small minus big, is a portfolio. It's a zero-cost strategy, okay, that buys small stocks and short sells big stocks. Okay, so the spread between if we compound it, if you have a look at it in the let's say we have small stocks that have, let's say, a return of which looks a little bit like this, a return evolution, and we have big stocks, and given that big stocks generate on average less returns across time than small stocks, so the difference here, the time series difference here, the spread is obviously the zero cost portfolio, okay, self-financing strategy that generates the size factor, and the sample average or the time series average here of that spread, that's our size factor. In the same manner, we have the value factor, which is a strategy that buys stocks that have a high book-to-market ratio, which are often referred to as value stocks, and finances this position by short selling stocks that have a low book-to-market ratio, respectively growth stocks. You are short in growth stocks and long on value stocks. And the same thing, obviously, we can just exchange this here by, let's say, by value, and this here becomes then obviously growth and the spread is the value premium, because value stocks tend to outperform growth stocks according to theory, respectively Farmer and French, and the spread then gives us the value premium. Okay, that's the value factor. So, and Farmer and French, they figured out that obviously these two risk factors, as they call it, they explain partially at least the cross-section of expected asset returns. Okay, so let's assume we have a beta 1 of some stock that is 0.8. If we run that model, beta 2, let's say, for example, is 0.6, and let's say the exposure against this value factor here is 0.3. So using these point estimates, let's say also, let's assume that the time series average of the market factor in excess form is 0.3% per month, and that the corresponding time series average, or that the expected return of that portfolio, this S&B portfolio, is 0.6, and that the expected return of the value factor is 0.7% per month. Using these figures here, we can simply plug in those numbers, and what we get is that the excess return of that asset here, given that numbers, is 0.55% per month, and which is larger, obviously, than the excess market return. So, and what's this model here has obviously an important feature, and that's the concept of correlation. So each of these, we have obviously three factors here. So K is, in our case, 1, 2, and 3. And obviously, in the recently, Farmer and French proposed a 5-factor model in 2015, where they add 2 more factors to the 3-factor model, and in 2018 they proposed a 6-factor model, where they finally added also the momentum factor. So different studies suggest different numbers for K, okay? So there, technically, you can take any anomaly, cross-sectional anomaly, and use it as a risk factor in your pricing model. So all of these models have something in common. They are linear, all right, and also, and the important thing is here that the point estimates for our betas, what's that? It's given by what? The covariance between factor K and the corresponding test asset here, test asset I, or asset I, divided by what? Divided by the variance of that corresponding factor. Yeah. So that's the important thing here, and we know already that the covariance can be rewritten in terms of its correlation. Yeah, when we are still, this model suggests that we are still in sigma expected return space. Okay, we are still here in the space that was originally proposed from Sharp. Yeah, it's the risk return space. Okay, and of course using these models here, because obviously the spreads here, according to Farmer and French, cannot be explained by the market factor. So using this model here, obviously it expands this mean variance space, it moves it upwards. So that's basically the idea of Farmer and French. Okay, still they use the concept of correlation, which assumes, again, which is designed for normally distributed random variables. So we see that half dozen of Nobel Prizes have been awarded, for basically work for the foundation, or for work that rests upon the PhD thesis of Louis Bachelier back in 1900, more than 120 years ago. So all these research has one commonality, and they use correlation-based methods. So the question now arises, how does this line up with reality? How does reality look like? So the normal distribution is obviously used and taught at business school as the return generating process of assets. And all the methods, or at least the vast majority of methods, and all those methods for which these Nobel Prize winners received this award are based on the assumption of the normal distribution, and all of them use methods that are designed for normally distributed random variables. Yeah, so this is an important issue, and let's have a look how reality lines up with the normal distribution. As the first evidence, let's have a look at the US stock market. Let's have a look at the US Dow Jones 30 index, which is an integrated or a basket of the 30 largest blue chip companies in the US. So what did I do? I downloaded data, daily data, in this case, for the US Dow Jones 30 index from the website stooq.com, covering the periods from 28th of May 1896 until 18th of May 2022. So we have here obviously more than 120 years of daily data, comprising 32,636 daily observations. I standardized the data to have zero mean and the variance equal to 1. And I do that in order to make a time series comparable, and because of if we use the standardization, we can read the returns as sigma in terms of its sigma. So here, what we see here, the plot shows us the time series evolution of daily Dow Jones 30 returns. And again, this is an index which consists of 30 large stock companies. And what we see here is the return series. And what we see already here in October in 1987, the huge spike downwards. There we have a 22 sigma event. The Dow Jones return was below it was, as far as I remember, minus 29%, right? And this corresponds to a 22 sigma event. But what we also see, we see a whole bunch of 10 sigma events, 6 sigma events, 15 sigma events. And recall, if the normal distribution would be true, these events we would never observe. So, for instance, on August 31 in 1998, the Dow Jones fell by 6.37%. And this drop corresponded to a 6 sigma event, or more precisely, 6.39 sigma. And it is interesting to know that a 6 sigma event, given we have the normal distribution, it should never happen in finite samples. It happens once every 1.38 million of years, and we don't have that data. So these events do not happen if the data is normally distributed. So given a data set of 32,636 observations, such an event should have never been observed if standard finance theory taught in business schools was true. So what are the facts? Here we have in this table, we see the facts on daily data. So in the interval from minus 1 sigma to 1 sigma, which is here on the right-hand side of the distribution, it is the dark blue part of the distribution. So we should have 68%, 34% on the left-hand side, on 34% on the right-hand side. So if the normal distribution was true, 68% of the observations would be there in the middle. It would be centered around or between plus minus 1 sigma. So what do we observe in real life? For the Dow Jones 30 index, we have 76 observations. 76% of the observations are plus minus 1 sigma. So 8% more than it should be, given the normal distribution would be true. So what does this imply? So if 68% of the observation, given we have a normally distributed random variable are within plus minus 1 sigma, then 32% should be obviously either below minus 1 sigma or above plus 1 sigma, yeah? Which we see here on the graphic. It should be the light blue area. Yeah? 16% on the left-hand side and 16% on the right-hand side. What do we observe in real life? Well, we see that in the Dow Jones universe, 23.92% are in that area. Yeah. And what is now very interesting to know, again, we don't even have 6 sigma events here on the graph, because in finite samples we would not observe these events. Yeah? So it should be 0 events. So observations either below 6 sigma or above 6 sigma should be 0 in finite samples. And what do we observe here for the Dow Jones 30? We observe that 0.25% of the observations, which are 83 daily returns, are either below or above 6 sigma. So we see that we can rule out the normal distribution for the stock index, for the Dow Jones 30 stock index, and you might have a guess that if we would use single stocks, this would be much more extreme. So now you might say, okay, this is daily data. The argument that some people usually have is, well, if we have lower frequented data, let's say monthly data or quarterly data, the distribution converges towards normal. And if you are a finance student, you might know that most of the studies that are published in these journals, they use monthly data for their asset pricing tests, right? So let's have a look how the same thing looks like using monthly data. So now we use monthly data, again the same index, it's index data, using monthly data, using the same time period, right, from 1896 to 2022, we have 1,507 monthly observations, and obviously this is only a tiny fraction of the data sample that we have for daily data. Yeah? It's only 4.6% of the sample for daily observations. Yeah? So therefore, I would say that perhaps in this case it's more reliable to focus on the deviations that are within plus minus 1 standard deviation, yeah? Because there we have the vast majority of observations, which we already know from the daily data. So again, what are the facts using monthly data? We see here the table. So between minus and plus 1 sigma, we have 77.5 observations. Yeah? So we see it is the same thing. Yeah? So the vast majority of observations are centered around the mean, are close to the mean of the distribution, yeah? Between minus 1 and plus 1 sigma. If the normal distribution assumption would be true, then it should be 68%. Again, we have much more observations that are centered than it should be given the normal distribution assumption. Also, obviously, we have less observations that are either above 1 sigma or below minus 1 sigma. Yeah? So we should have 32% of the observations in that area in the light blue line of that graph, but in real life we have only 22.5%. And what we also see, again, even if we have just a very tiny fraction, only 4.2% of the daily observations, we have just a small sample here, but still we observe 6 sigma events. We observe two 6 sigma events which should have never happened if the normal distribution assumption would be true. So, and this corresponds to 0.13% of the sample. And again, obviously, these 6 sigma events, obviously, these are low probability events which are, per definition, you would not observe them in a high frequency, okay? So that's why using monthly data, because we have just a small sample available, we obviously cannot observe equally many as for daily data. But that does not mean that it is the same data generating process that is behind. So now we have seen the equity index, the American equity index, proxied here by the Dow Jones 30 index, which is obviously the most known index and which has the longest history. And now you might wonder, okay, this might be a phenomenon which is just related to stocks, but probably not to other asset classes. So let's have a look how this looks like for the exchange rate market. And as I just chose the euro to US dollar exchange rate, and for the vast majority of exchange rates, it is the same thing, or it's much more severe. But let's have just here a look at the euro US dollar exchange rate. So I downloaded daily data. Obviously, I use here now only daily data because there's not much data available. As you might know, the euro started trading in 2000, so we have only roughly 20 years of data available, but that's sufficient for daily analysis. So I downloaded daily data for the euro US dollar exchange rate from the website yahoo.com. They have a category finance that you might search for in the internet. If you open the website Yahoo, you can push the finance button, then you will come to that area where you can also retrieve data. So this data set covers the period from December 1st, 2003 until November 19, 2021, comprising 4,690 daily observations. Again, I standardized this data series to have a zero mean and a variance equal to 1. What you see here is the plot of the standardized data series for this exchange rate. And you see already compared to the equity market, if we go back, you see here the equity market. It looks more, let's say, more in movement. So the exchange rate series it appears to be more smooth, right, compared to the equity market. So it looks more smooth on the outside, with some outliers there. Okay, so we have seen one 22 sigma event for the stock market, for the Dow Jones 30 index. Here we see at least two 20 sigma events, one 20 sigma event and one 25 sigma event. And we see a bunch of 15 sigma events, even though if you just would see the right-hand side, just the second sample here, from that time series, you would probably think that this is a very smooth data series, right? So you might be surprised. So again, let's have a look on the facts. Now we have here the table again, the facts based on daily data, 4,690 observations. So how many observations do we have? Between -1 and +1 sigma, it should be 68% if the normal distribution would be true. But here we have even more. We had, you might remember, at the Dow Jones 30 index, we had between 76 and 77% of the observations were minus and +1 sigma. Here we have 82.47%. It's even more, it's even worse. And 17.53% of the observations are either below 1 sigma or above 1 sigma, and it should be 32. So it's almost only half of the observations that we have here in that area, in this light blue area. So, and now the interesting thing again, 6 sigma events we should never observe in that sample if the normal distribution would be true. But still, we observe 10 events that are larger than 6 sigma standard deviations. So we have 10 events that are at least 6 sigma. We have seen on the graph, if we go back, some of them are 25 sigma. These events should never ever happen. So relative to the sample, this corresponds to 0.21% of the sample, and it should be 0 if the normal distribution would be true. Okay, you might say, okay, probably it's just related, this phenomenon is just related to the stock market and to the foreign exchange market. But what about other markets? Let's have a look at the crude oil market. So compared to the foreign exchange market, the crude oil market, if you just consider the left-hand side, yeah, so the first subsample, if you just have the data of the first subsample, you might think this is a very, very smooth process that has almost no variation, yeah, compared to the foreign exchange market. Yeah? So we see, you might think just at the from visual inspection that the stock market is probably the most volatile. Then you would see here. Second might come here the foreign exchange rate market, and then the crude oil market, which is a commodity market, comes third. Yeah, but you might be surprised. So I downloaded data for crude oil from the website yahoo.com, covering the period August 23, 2000 until March 31st, 2021, comprising 5,190 daily observations. Again, I used the same procedure. I standardized the data to have 0 mean and variance equal to 1. And here you see the plotted time series over that period. So you see, towards the end of the sample, you see 50 sigma events, okay? 50 sigma. This is enormous, yeah, and this, again, you would never observe these events if the normal distribution would be true. So what about the facts? Again, here we have the table, and you see here there are 95.18% of the observations are between -1 and +1 sigma, and it should be 68%. So you might know from statistical testing, usually in finance and in most other social science, use the so-called t-statistic, and you would argue that something, whatever you measure, is significant if it either exceeds 2 sigma, if the t-statistic is larger than 2, or if it's less than -2. Yeah? So you would say, okay, because you know if in the normal distribution 95% of the observations are between -2 and +2 sigma. Yeah? So whenever something is above 2 sigma, you would think it's significant. But obviously here, 95% of the probability is not -2 and +2, it's -1 and +1. Okay? So you would obviously do wrong statistical inference if you use the normal distribution for something that is distributed like that. So again, the vast majority, almost all, 95%, are centered very close to the mean of the distribution, yeah, between -1 and 1 sigma. And only 4.82% are either below -1 sigma or above 1 sigma, which you see here again, which is the light blue area in that distributional graph, which you see here on the right-hand side. If the normal distribution would be true, again, 32% should be there. So again, we have a huge deviation here from what we observe empirically and what is taught at business schools. So again, the interesting thing is, again, the extreme events. Okay, do we have anything which we should, if theory would hold, never be observed? Yes, of course. There are 3 events that exceed 6 sigma. Yeah, and we know already there are huge drops here in the crude oil market, which took place, obviously, during the outbreak of the worldwide corona pandemic, right? So the crude oil return was minus 57.41% on April 20, 2020, and one day after that it was minus 23.75. According to Benoit Mandelbrot, the odds of the stock market crash on October 19, 19 1987, where the Dow Jones Index fell by 29%, corresponded to a 22 sigma event. And the odds were 1 to 10 to the power of 50. Odds so small they have no meaning. It is a number outside the scale of nature. You could span the powers of 10 from the smallest subatomic particle to the breadth of the measurable universe and still never meet such a number. Now, these are the words from the great Benoit Mandelbrot on page 4 of his book, The Misbehavior of Markets. Yeah, so you might think this a return of minus 57, which we have seen here on the previous graph, it is a 50 sigma event, all right, and the day afterwards is roughly a 20 sigma event. Yeah? So you might think about the odds. If the odds of a 22 sigma event are 1 to 10 to the power of 50, which is, this number, you cannot even imagine what that is. And now we have two events. The one is is twice as severe, and the other one is as severe as the event on October 19, 1987 for the stock market. And to observe two of these on 2 consecutive days, or on two subsequent days, you can think about how likely it is to observe that. So again, we can rule out the normal distribution. This assumption is completely wrong, even for the crude oil market, or especially for the crude oil market. As a final example, let's have a look at a stable cryptocurrency, the cryptocurrency or the stablecoin Tether. Cryptocurrencies have become popular in the wake of the financial crisis. The first cryptocurrency traded was Bitcoin. As of recording this lecture, it is still traded. Who knows how long? And a couple of years later, because of Bitcoin has a very high volatility. So in order to address this problem, developers came up with the idea to peg cryptocurrencies to real life money, and the stablecoin Tether is pegged to the dollar. So if you pay $1, you should get 1 unit of Tether, and vice versa. That is the idea. Pegging to another currency is obviously nothing new. This has been done earlier. For instance, the Mexican peso, as far as I'm concerned. So what did I do here? Again, I downloaded data for the stablecoin Tether from the website yahoo.com, covering the period November 9, 2017 until June 26, 2022, comprising 1,693 daily observations. This is obviously the smallest data sample, and you would probably not expect any 6 sigma events, not for that sample. So what did I do? I again used the same procedure. I standardized the data set to have 0 mean and the variance equal to 1 in order to make it comparable, and I plot here the standardized data series. Visual inspection, you see already that there are a couple of 10 sigma events, or of events that are actually exceeding 10 sigma. Again, you should never ever observe these events if the normal distribution was true. And you see even a couple of 5 sigma events on the left-hand side of the sample. If you just would see the right-hand side of the sample, you would think, wow, this is a very stable asset. Right, there's almost zero variation, but you might be surprised, if you enter the other sample of the data series. So what are the corresponding facts based on daily data? So we see that we have 86.89% of the observations are between plus minus 1 sigma, and again it should be only 68%. It's the blue area here on that graph. 13% obviously are either below minus 1 sigma or above 1 sigma, and it should be 32% if the normal distribution was true. And the interesting thing is here that from all the data series, from all the financial assets that we considered here, it is actually the stablecoin Tether, yeah, that has in relative terms the largest amount of outliers or of Six Sigma events. Yeah, so we see that 0.30% of the distribution are events that exceed Six Sigma, and we would never observe them if the normal distribution was true. So in total, it's 5 out of 1,693 observations that basically were above or below Six Sigma. And you might remember from the stock market, the Dow Jones 30, it was 0.25% of that sample, which was much, much longer than the sample that we have here. So overall, yeah, obviously, we see strong evidence against the normal distribution, all right? And we will talk about the implications later on, but as of now, the takeaway is here that none of the financial assets has the corresponding distribution that is used in the methodologies taught or used in business schools. And let's have a closer look at the commonalities of all these financial assets on the whiteboard. So now let's have a look at the commonalities, what we just discussed. We can illustrate here 3 types of distributions. Let's start with the black curve here. Yeah. We have on the x-axis the sigmas, yeah, the standard deviations, which give us basically the distance to the mean in always equal steps, right? Here we have the mean is 0, and we only consider the positive payoffs or the positive returns of each of these distributions. The black line here, the black curve, should illustrate the normal distribution. Yeah, it's a thin-tailed distribution. We have here the blue line, the blue curve. It should illustrate the Dow Jones 30 returns, whereas the red line, which is obviously the most extreme here, the red curve, illustrates the price changes of the oil market. Yeah? So we can think of it here, or I think of it like this for illustrative purposes. So the probability that the realization x is smaller than 1 standard deviation, I call this the zone 1. The zone 1 is gives us the observations that are centered, close to the center. Yeah? The observations are close to the center. The zone 2, there we have the observations that are larger than 1 standard deviation, and we can think of it either larger than 1 standard deviation and smaller than 6 standard deviation, or we can just think of it as observations that are larger than 1 standard deviation. Yeah? Because we know already that there are, for the normal distribution, we do not expect observations that are larger than 6 standard deviations. Okay? So that's the zone 2. These are the observations that are away from the center. And we can think of a third zone, zone 3. Here we have the realizations, the probability from x larger than 6 sigma. Okay? These are the 3 zones, the 3 categories, clusters that we can think of in terms of observed realizations. Yeah? So 3 zones, close to the center, away from the center, and the zone 3, the impossible events, yeah, for the normal distribution. Obviously, as we have seen from the empirics that we went through, if we compare the normal distribution and the empirical fat-tailed distribution, what we can observe is that zone 1, there are less observations for the normal distribution in zone 1 than for fat-tailed distributions. Yeah? We have seen, for instance, for the oil market, there are 95% of the observations, yeah, 95% of the observations are here. Yeah? They are in one standard deviation. For the normal distribution, we might remember, if we consider the normal distribution, we said, okay, there are 68% of the observations between -1 and +1 standard deviation. Yeah? And for all of the other distributions, we recall for the Dow Jones 30, there were around 77% were in zone 1. And again, for the normal distribution, it should be 68%. Yeah? So we can say that for all of this empirical pair of distributions, there are more observations in zone 1 than for the normal distribution. So for zone 2, so if you consider the observations that we expect that are above 1 standard deviation, this is zone 2, the observations that are far away or away from the center, we see for the normal distribution, recall how we have 100% minus 68, 32% we would expect in zone 2, but for fat-tailed distributions, there are less than 32%. For instance, for the oil market, we recall there are around 5% only in zone 2. And for all of the other empirical distributions, we have seen that are by far less than 32% of the observations are above 1 standard deviation, which I also illustrated here through the 3 graphs. Okay? So we can say that for the normal distribution in zone 2, we have more observations in zone 2 than we observe for fat-tailed empirical data. Finally, for the third zone, the impossible zone, we see that we have observations for all of the empirical data generating processes, but we would not observe in finite samples any observations above 6 sigma for the normal distribution. So we can say for the impossible zone, which is here, from 6 sigma to infinity, we expect more observations for fat-tailed data than for the normal distribution, given we operate in finite samples. We can also illustrate it like this. So let's plot on the x-axis the sigmas, like here above, but now we plot here on the y-axis the probability of x larger sigma. So we know the probability for x larger 1 sigma, given that we are in the normal distribution world, is 32%. The probability of x larger 2 sigma is 5%. Yeah? And recall that we have from 2 standard deviations, from -2 to +2, there are 95% of the observations. Yeah? So 5% are larger than 2 sigma. Yeah? And for 3 sigma, it's only 2%. So we see an exponentially decay of the probabilities as we move on here on the sigma axis. And of course, recall, we would not observe any observations larger than 6 sigma in finite samples for the normal distribution. So we see an exponentially decreasing function here. But if we consider the empirical data, what we see is a quite different phenomenon. Yeah? Again, we plot on the x-axis the sigma, so the sigmas, and on the y-axis the probability of x larger sigma. And now we are in fat-tailed, you consider fat-tailed data or real-life data. Yeah? So if we just, as an example, recall Tether, the stablecoin Tether, we see that 13.8% are larger than 1 standard deviation. Yeah? So it's obviously this here moves down. In real life, we observe much less than 32. It starts somewhere here. Yeah? But then we see that the decrease it's not exponential. It's much less than here. It's much less. It's much smoother than here. So the derivative, the absolute amount of the derivative, is here much larger than it is here, because the slope is much less steep. This slope here, the derivative, it is very steep, but it's not the case here. And the same is true as we move from 2 or 3 standard deviations. Yeah, we see that's almost the same. Yeah, the curve is much less steep than here. So it's a very different decrease. It's a very different decrease. So we can think of it if we would write both graphs in the same plot. Yeah, it would look something like that. Yeah, so we would even move here, we would observe here in 6 sigma still observation. So the probability here from P to the probability from x larger than sigma is not 0 as we move to 6 sigma for fat-tailed real-life data. But for the normal distribution, it's already 0. It goes here to 0, yeah? At least in finite samples. So this is how we can think about it, about the commonalities that we just discussed. So let's move on. How reality looks like. First, we have talked about the distribution, yeah, in order to have some empirical examples. What about other assumptions in financial economics? Yeah? Obviously, this slide is entitled Other Shaky Assumptions. So first of all, people are rational and aim only to get rich. Yeah, you might remember that the capital as a pricing model assumes that investors act rational. So in his book, Benoit Mandelbrot comes up with the example of the game flipping a coin and winning $200. Obviously, it is used in a different manner depending on whether one can potentially win something or whether one can potentially lose something. So if someone asks you, or most people, if you would either get $100 immediately, or you could throw a fair coin where the probability is 50% of a head or a number, and on expectation you would get 0 times 200, 0.5 times 200 plus 0.5 times 0, which is on expectation $100. So the outcome is the same thing. But most people, if you would have been given this choice, they would take the secure payment. So they would choose $100 immediately instead of playing the game. But most people act differently if you are in a different scenario. So now, if you are now in the scenario that you can either lose $100 immediately, or you can play the same game. You again flip a fair coin, and you either lose $200 or you lose $0. So if this is the case, most people would choose the game as opposed to paying $100 immediately. So it is the same game. It is basically the same situation. And if people would be rational, they would choose the same thing for both situations. But this is obviously not how people's mind works out. All this is also, there's actually a theory behind it. It's the prospect theory developed from Daniel Kahneman, who, by the way, also was a Nobel Prize winner back in the days. And even in economics, there's a special field of economics that addresses this issue, which is called behavioral economics. Yeah? So people are not rational. Yeah? They're anything else but not rational. But this is in turn one of the assumptions of traditional finance. Second, all investors are alike. Again, if we go back to the CAP-M model, yeah, obviously it deals with a representative investor. Yeah, but are people really homogeneous? No, they obviously are not. People do not act in a homogeneous manner. Yeah? If only have two groups of people, Let's say one of group of people are value investors, the other group of people are growth investors. If only two group of people are taken into account, the market switches from a linear system to a non-linear chaotic system in which factors interact and generate the unanticipated. Yeah? And if we have a look at just as a practical example, just think about the universe of investment funds. You will find in investment funds for anything. You will find investment funds that invest in or that focus on value stocks. You will find investment funds for retail small stocks. Yeah? You will find investment stocks, or you will find investment funds that invest only in blue chips. You will find investment funds that invest in, let's say, social responsible acting firms. Yeah, you will find or green firms. You will find anything what you're aiming at. You will find investment funds that are just focused on real estate firms. So obviously, not all investors are alike. Yeah? Obviously, people have different preferences. Yeah? So and as we have been discussed here, if we have only two groups of people, things become very complicated. And now you might think about if we have something like 100 different clusters of behavior. Yeah, so obviously things become very, very complicated, much more complicated than traditional finance theory assumes in their models that are taught in business school. Next, the third point here, price change is practical continuous. Yeah? So obviously, if you are in business school and you have your finance courses, even on doctoral level, all these theoretical models, at least as far as I'm concerned, and this is how I learned it when I did my doctoral education. Yeah, all these models, they use the Brownian motion, yeah, a continuous time Brownian motion to derive their theoretical frameworks. Yeah? So they assume that the price change is continuous. But discontinuity, far from being an anomaly, best ignored, is an essential ingredient of markets that helps set finance apart from the natural science. These are Benoit Mandelbrot's words on page 86 in his book, The Misbehavior of Markets. And discontinuity is manifested in these 6 sigma events, respectively those events that exceed 6 sigma, which we have discussed here across different asset markets already. So finally, price changes follow a Brownian motion. And this assumption incorporates 3 other assumptions, 3 sub-assumptions, if you like. First of all, price changes are independent. Second, they are stationary. And third, they are normally distributed. So there are obviously strong cases against that, against the assumption of independence, which we will talk about later on. There's a huge literature on momentum research, and I actually conducted a whole bunch of studies that are related to that as well. And momentum suggests that there is a dependency, a strong dependency, a positive autocorrelation. That is that cumulative past returns predict future returns. Yeah? So if stocks have performed very, very well in the past, let's say 12 months, they should or they are expected to generate higher returns in the holding period, in the, let's say, 1 month holding period, than stocks that have performed very poor in the last, let's say, 12 months. So there's a whole huge amount of literature that suggests that there is dependency in asset returns. Second, stationarity. So obviously the stationarity assumption, it means that the past or that the future will be like the past, so that the past repeats itself. Yeah? So the past samples tell us something about what will happen in the future. That is basically, in essence, what stationary means. But obviously, discontinuity, what we already discussed, is obviously contradicts the stationarity assumptions, yeah, because these events are unexpected, yeah, and we have you have seen that there are some that we have one sample where nothing happens, and in the other sample, obviously, all of a sudden we have these huge spikes, these huge deviations, and this should not happen if the data series would be stationary, okay? And the normal distribution we have already discussed. We can rule out the normal distribution for any asset market. So obviously, the whole theory or the whole framework, the whole theoretical framework of traditional finance theory, it has a very shaky foundation. Yeah? So basically, none of these assumptions holds for empirical data. So now let's discuss briefly some recent examples for discontinuity, because this is basically what we will talk about a little bit more in detail here in this lecture series. So, and I take now here some recent examples of the past year. Now we have June 2022, and I downloaded one year of daily data. Obviously, this year we had the outbreak. First of all, we had, like in 2020, the outbreak of the global corona pandemic, where stock markets crashed worldwide. All right, and now 2 years later, and the pandemic is not over yet, but now 2 years later, we have the first war again in Europe after 60 years. So the Russians attacked the Ukraine, and this had obviously, like the corona crisis, a huge impact on the stock market. Yeah, and this is basically what I would like to show here. So this is obviously not expected, but it happened anyways. Yeah. So what happened when the Russian army attacked the Ukraine? So we have here. Let's consider first the Russian stock index. Yeah, we see the Russian stock index. It dropped below -30%. Yeah, it was even more severe than the Dow Jones 30, than the drop in the Dow Jones 30 index in 1987. Yeah, and as of 1987, no one has ever experienced this kind of event. But all of a sudden, it just occurred. And the same thing here again. -30% return for the Russian index, which corresponded, if we standardize the series, to a 10 sigma event. We would, if the normal distribution would be true, we would never observe that. At the same time, the largest Russian bank, the Sberbank of Russia, it dropped close to -50%, a -50% return in spring 2022. So again, if you standardize the series, you will see that also this event corresponds to a 10 sigma event, which is an impossible event, and yet you see it, you observe it anyways in real life. At the same time, or we see here the German weapon company Rheinmetall. They produce weapon for the NATO and for the German army. So you see that obviously they have high orders now. The German army or the German government was forced to increase the spendings for the weapon industry to produce more weapons, also for the NATO. So we see a huge increase in stock prices. So we had a return of 25% in the wake of the outbreak of the war here in Europe, and which corresponds to an 8 sigma event if you standardize this time series. Again, you would never observe such an event. And also what you see there a couple of months later, in May 2022, we had a return of -15, which is probably something like a 5 sigma event. Also, very, very unlikely event, which you should not observe within a 1 year sample. So then we have another thing which is unrelated to the war. We have the American social media company Snap. Yeah? Snapchat is, so they have like an app for social media. Yeah? And this company is obviously, you see, it has some enormous discontinuities. Yeah? You have, in the beginning of the sample, you see a 20% return in 2021, in July 2021, yeah? And you see in February 2022 a return of 60%, yeah? Of 60% on 1 day. Yeah? And if you standardize the series, you will see that this corresponds to a 9 sigma event. Yeah? Something that you would never observe in a sample covering 250 trading days. And then, back then, you see also in the towards the later sample, in May, in the end of May 2020, we had a return of -40, yeah? which corresponds, if I remember correctly, it's roughly a 5 sigma event. So we have a whole bunch of unprobable or low probability events within only 250 trading days, yeah? Across unrelated stocks or stock markets. So we see this is obviously, as I told you earlier, which we observe for stock index, the Dow Jones 30 index. We observe obviously, if you consider single stocks, we can observe much more extreme discontinuities, yeah? Which might be no surprise, as we have just one single asset here that we consider. So some example for dependency and discontinuity in price changes. As I mentioned earlier, the momentum strategies. Yeah? So the momentum strategies, as proposed by Jigadesh and Titman, yeah, in the seminal paper from 1993, the strategy buys stocks that have performed well in the past, and it sells stocks that have performed poorly in the past. So according to the authors, those strategies generate significant positive returns over 3 to 12 months holding periods. And it's interesting to note that their 1993 paper, which was published in the Journal of Finance, of course, yeah, it was cited more than 14,000 times. Yeah? So you can think of that as an enormous body of research that is devoted to investigating the momentum effect across different asset markets, even though most of the studies are exploring this strategy or this anomaly in the stock market. So the most common strategy that is used also in asset pricing models is a strategy where you have the stock universe and you divide it into, let's say, 10 groups of equal number of stocks and you allocate those stocks with respect to their cumulative return from month minus t minus 12. From now, if now t is 0, you cumulate the returns. You go back to 12 months in the past, t minus 12, until t minus 2. So you do not consider the most recent past month. So you skip the most recent past month, but you cumulate 11 months, like t minus 12 until t minus 2. So accumulate the returns, and those stocks that have the lowest return in those time window, yeah, in the past, roughly in the past year, these are the loser stocks, yeah, and those that have the highest return, the highest cumulative return in their time window, in the past time window, these are the winner stocks. Yeah? You short sell the loser stocks, take the money, buy the winner stocks, and you keep this portfolio in the holding period constant, and usually you take a holding period of 1 month, and then you rebalance your strategy. So this strategy gives you, on average, a return of 1% per month, according to the authors. The interesting thing is that this strategy is said to be among the most pervasive asset pricing phenomena and present across virtually all asset markets. Yeah? Again, there are 14,000 citations. there were recently some authors have been doing a replication of 450 asset pricing anomalies, including obviously this momentum strategy, and they argued that the average return is about 1%, or it's in their replication it was 1.16% over the sample from 1967 until December 2016, and the t-statistic is 3.99 according to the authors. So the reference study is entitled Replicating Anomalies, published in the Review of Financial Studies, and the authors are Huxu and Xang. So what do I do here? You see here I plot this momentum portfolio. Yeah, it's a zero-cost strategy again. You short sell the loser stocks, and you buy the winner stocks, keep them one month ahead, and you do the same thing again. Yeah, it's a iterative strategy. Yeah, you do the same allocation every month again. So you see here the strategy from, or the compounded return from 2000, from April 2002 until April 2022. So over a 20-year period. We have here a 20-year period. So I set the initial return, or the initial amount of money invested is 100, and then I take into account the interest of interest effect, which is so I calculate the compounded return. Yeah, so that is, if the strategy gives you a return of, let's say, 10% in the next month, you would get 110. If you then get, again, if you then lose 10% in the second month, you have to compound, you have to calculate 10% from 110, and so on and so forth. So you always take into account the compounding effect. And this is also what you're interested in. If you're an investor and you invest, let's say, $100 at time zero, you are interested in the money that you get out at the end of the sample, right? You are interested in the compounding effect, in the compounded return. You're not interested much in the average return. You see, the interesting thing is here that over the sample, the average return was 14 basis points a month. It was a positive average return, all right? 14 basis points per month. But you see, the compound return was negative. If you would have invested $100 back then in April 2002, you would have gotten out now 53. So you would have lost half of your money. And why is that? So obviously we see here two huge drops, discontinuities. These drops are discontinuities. Returns in March and April of that strategy, of this well-known momentum strategy, in March and April 2009, so this was in the wake of the financial crisis, we had minus 40% and minus 45% return, which corresponds to two 5 sigma events in two subsequent months. So I used obviously monthly data, okay, monthly data. So, which is obviously, this is a huge loss, okay? It's huge, and which you also see here in the graph, and you would have not recovered from it. So over even if you had invested 100 units or $100 in the beginning of the sample, you had, let's say, 9 years later or several years later, this huge drops. Even if you would have kept this, you would have followed this strategy over a decade ahead, you would have not recovered. Yeah, you would have lost you lost half of your money. So again, obviously, in this environment, t-statistics make no sense. Yeah. So let's move on. Let's talk a little bit more in detail about that. So what I did now is, okay, in the upper figure here, it shows the compound returns for the price momentum strategy, yeah, based on prior 11-month returns, using a 1-month holding period, based on the original sample used in the study from Jägerdesch and Tittmann in the 1993 paper. And the original sample is from January 1964 to December 1989. Yeah? So it's obviously it's a 25 years period. Yeah, you see that if you see the figure, the upper figure, that there's an almost exponentially increase in compounded returns. Yeah? So you would think that this strategy pays. It's a money making machine. Yeah? And an interesting thing is also, which also the authors write in their follow-up study from 2001, where they replicate or where they extend the sample from 93 to 2001, that the strategy is still profitable, and that many hedge funds use this strategy in one form or another. So it might be not surprising that some hedge funds, or that hedge funds from time to time blow up. So if you would have trusted that strategy, yeah, you obviously would have a pretty much let's say bad luck later on, because in the lower figure shows the compounded returns for price momentum using the same strategy, but for the overall sample. Now I expand the sample from January 1965 until April 2022. Yeah, so I account for these huge drops, and what you see here is it's a completely different strategy. Yeah, so you might expect what you see in the upper figure, and what you get if you see the whole sample, the whole picture. What you get is what you see in the lower picture. So it's a completely different animal what you see here, right? So obviously, you see the first, if you do not take into account potential discontinuities, yeah, you would be deceived by the first subsample that the authors have been using. All right, because in that subsample, you have not observed the discontinuities yet, but it does not mean that they will not come. So let's move on, and let's a little bit dig deeper into this issue. So here we have, as an example for dependency and discontinuities and price changes, we are still having the same topic. So we want to explore now what is the actual effect, how strong is the effect of discontinuity on the compounded returns. So the gray line here, it shows the compounded returns of the momentum portfolio where I deleted 1%, only 1% of the observations. Since I have 688 observations in the overall sample, 1% are 7 months from that sample. So I exclude those months that have the highest volatilities, which you see here in this table. Yeah? So for instance, the highest volatility had this strategy obviously in April 2009, where the return was minus 45%. And the lowest of the highest 7 returns was obviously in February 2000, and it was a positive return of plus 23.81%. So the gray line obviously shows this evolution, yeah, and it gives you a payoff. And again, I start with 100, like in all the other examples. You would have the final payoff is 552,132 in compounded returns. So the black line shows the evolution of the compounded returns of the original momentum portfolio, whereas the compounded return at the end of the sample is only 50,702. So you see there's a huge discrepancy if you exclude the discontinuity. Yeah? So you see that if you exclude the discontinuity, you see that 1% of the largest impact returns correspond to more than 90.82% of the overall total of compounded returns. Yeah? So obviously, these discontinuities have an enormous impact on the cumulative total of the compounded returns. You see in the gray line, there's a strong dependency. You see But this dependency is interrupted by discontinuity. So you see there's an interaction between dependency, which is disrupted by sudden discontinuities in the return series. So now we have seen so far statistical issues and issues that are related to the distribution, but what are other consequences when people rely on wrong models? So we have said earlier that Merton and Scholes, they were co-founders of a huge hedge fund, the long-term capital management. And concerning this hedge fund, Nassim Taleb, who is a well-known author and intellectual, he documents on pages 281 and 282 in his book The Black Swan the following. Robert Merton Jr. and Myron Scholes were founding partners in the large speculative trading firm called Long-Term Capital Management, or LTCM. It was a collection of people with top-notch resumes from the highest rank of academia. They were considered geniuses. The ideas of portfolio theory inspired their risk management of possible outcomes, thanks to their sophisticated calculations. They managed to enlarge the ludic fallacy to industrial proportions. Then, during the summer of 1998, a combination of large events triggered by a Russian financial crisis took place that lay outside their models. It was a black swan. LTCM went bust and almost took down the entire financial system with it, as the exposures were massive. Since their model ruled out the possibility of large deviations, they allowed themselves to take a monstrous amount of risk. The ideas of Merton and Scholes, as well as those of modern portfolio theory, were starting to go bust. The magnitude of the losses was so spectacular, too spectacular to allow us to ignore the intellectual comedy. Many friends and I thought that the portfolio theorists would suffer the fate of tobacco companies. They were endangering people's savings and would soon be brought to account for the consequences of their Gaussian-inspired methods. None of that happened. Instead, MBAs and business schools went on learning portfolio theory, and the option formula went on bearing the name Black-Scholes-Merton. Yeah, it's interesting to note that this hedge fund, it managed $7 billion. Yeah? And this hedge fund was liquidated and dissolved in early 2000. Now recall that Robert Merton and Myron Scholes, they received the Nobel Prize for that, for something that almost blew up the whole financial system. Yeah? And these people were considered geniuses. Yeah? So these are interesting things. Yeah? So we see, obviously, in the industry, if the industry uses these kind of methods, based upon correlation and based upon the assumption or derived from anomaly distribution as the core assumption, obviously, if you rely on these methods, your hedge fund might sooner or later blow up. And obviously, what we will discuss in the forthcoming lecture series, we will see that all the correlation-based methods that are taught in business schools, that they make no sense, that they are invalid, that they give wrong results, respectively sample-specific results, if you use them for financial data. So, what is next in the lecture series Fractal Finance? So in the lecture that follows, we will discuss more on the mathematical implications of especially discontinuities and the consequences for correlation-based methodologies applied to financial market data. Thank you for your attention.